Welcome, everyone, to today's presentation, Mastering Financial Literacy. Today's discussion, word to the wise, is for educational purposes only. It's not meant as a one-size-fits-all sort of solution, so please reach out to your advisor for information specific to your situation. Also, a copy of this webinar will be emailed to all registrants as soon as possible. So with that, let's get started. In today's presentation, we're going to be busting 20 common financial myths. Today's speakers are on your screen now. I'm Josh Brockwell, Investment Communications Director here at Azad Asset Management. I'm responsible for all things marketing and spearhead our shareholder advocacy program. Raj Mahmood also joining us today. He's an investment advisor with Azad, also a certified financial planner. Ata Khan is a longstanding analyst and associate with us at Azad, also with his Series 65 license. And last but not least, our president and CEO, Bashar Qasim, is joining us today. He's one of the first in the United States to earn the Certified Sharia Advisor and Auditor certification from AOFI, the Accounting and Auditing Organization for Islamic Financial Institutions. That's unique because Bashar is an investment advisor with 30 years of practical knowledge working in the financial services industry. All three gentlemen work with individuals, families, business owners, and nonprofits across a full array of comprehensive financial planning areas, including retirement, estate, and tax planning. Thank you all for being here today. A little bit about Azad before we delve into our topic for today. The company was founded in 1997. Today, we manage around $1.5 billion in assets for our clients. So we have a long history of halal investment management. We combine that investment management with holistic financial planning that includes retirement, tax, charitable giving, and estate planning. We like our clients to think of us as their personal CFOs or chief financial officers, if you will, well-versed in Islamic financial principles. So now that you know a little bit about us, I'm going to hand things over to Ata Khan to get things started. Ata, over to you.
Thank you, Josh. So let's get started with our first myth, that is savings, investing, and speculating are the sides of the same coin, or they are one and the same. So let's set aside speculating for the moment and take a look at savings and investing. And while two of them are incredibly important habits to develop, especially for achieving your financial goals, they're not the same thing. They both set aside money for future use, but there is a big difference in how we approach each of them and how each of them can help you achieve your goals. So let's get started with savings, which is basically a form of setting money aside in a low-risk liquid account. And we can use this money for emergencies, short-term goals, or unexpected expenses of different sorts. So for instance, if you're in the market looking for a house and you might have set money aside, which might be tapped into 3 to 6 months later, and that would be money that you have saved essentially. But more than often, saving isn't enough on its own. Inflation on its own can, erode the value of your money. So investing becomes that much more critical. And in fact, for our clientele here, for whom savings in riba-based or interest-based savings account is not permissible or acceptable, investing becomes that much more important for achieving your financial goals. So investing is when you put or invest your money in stocks or halal fixed income, real estate, or even your own business, and it offers you a higher return for achieving the goals that you're aiming to achieve. But there is a certain degree of risk involved, and that is the cost of cost of being invested. So there are obviously no free rides, but done properly, investing is a carefully planned and prepared approach to managing your money with the goal of accumulating the funds you need. But keep in mind that your investment strategy is about discipline and patience. So just like diets and exercise regimens, results don't show up overnight. Sometimes consistency and patience is what delivers your results. So let's talk about speculating, which you set aside earlier. It's not the same as investing because speculation is where we aim to make quick profits by betting on short-term price movements. So there is a very high degree of risk involved here, and where investors would structure their total portfolio to capture unexpected market growth over time. Speculators make concentrated bets based on market trends and predictions. So speculators often do not understand what risk they're taking on or what risk they're getting into uh, because of this very nature. And they often mix emotions into the investing process, which is a recipe for disaster. So to be financially successful, we would recommend keeping speculating at a bare minimum and have a structured portfolio where you understand the risks and where you are consistent and patient. So let's jump on to myth number two, which is mistaking luck for skill. This is something that we read about in Morgan Housel's The Psychology of Money. This is an incredible book, especially if you're trying to get into the world of investment finance and trying to understand the concept of money and finance and want an easy book to read. In this book, Morgan says that luck and risk are the opposite sides of the same coin, but for some reason, we treat them very differently. We view one as incredibly important and the other like it doesn't exist, or at least till you succeed. So, in investing, a huge amount of effort goes into identifying, managing, calculating risk. But such little effort goes into doing the same for luck. So, for instance, when you purchase a few stocks and they go up the next day, do you associate it with luck or skill? Do you respond by saying, "Man, I got so lucky," or do you pat yourself on the back and say, "I'm a genius"? But and especially if you're like a lot of long term, like a lot of do-it-yourself investors, these moments might have you make second guessing the need for a money manager in the first place. But my question to investors like these are, can you replicate your process? And more than often, what I hear back is what process. And to clarify, I'm not asking you what whether or not you can recreate your results. Not even the best money managers in the market or in the world can promise to recreate results. What I'm asking you is, how did you go about the investment process? What is your methodology? What is the recipe you used? And if you can't describe that, then more than often, your results were based on luck than by any investment philosophy or strategy. And that's not to say that even the most experienced money managers will underperform the market at some point or the other, or they might not even outperform the market every single time. And which is why instead of chasing performance, we advise clients to focus on a few important questions when approaching money managers. And so you can ask them stuff like, does it provide you the diversification that you're looking for? Does it help you reduce the portfolio's risk? What is the track record of this money manager? And for our audience today, specifically, what is the process when it comes to delivering a halal portfolio? Is it a robust and dynamic process that takes into consideration the ever evolving world of finance? Or does it just give lip service to halal investing? Myth number three, I am too young to start investing. Or closely related, I don't have to start investing for retirement. Uh, the reality is, the sooner you start investing, the more time your investments have for potential growth. Waiting too long can make it very difficult to catch up. So let's look at this example in front of us right now. We are making certain assumptions here. We're assuming that we're investing $3,000 at the end of each year, and you're investing it at an annualized return of 6% and retiring at 66. So if you look at the first line, the one that goes up in blue, I believe, if you start off investing $3,000 at the age of 20, and with investing it at 6% or till the age of 66, you end up with an accumulated wealth of approximately $680,000. And if you delay this process until 35, which is you start saving at 35, with the same assumptions, you'll accumulate about $250,000. And if you wait until the age of 45, you'll accumulate about $120,000 by the time you're 66 years old. So how much should you start investing, or how much should you be investing? Well, generally, it's recommended that you invest or save at least 15% of your income every year. And that could include your employer contributions. And obviously, higher income earners should be aiming beyond 15%. Now, this is a general rule of thumb. I would highly recommend touching base with your investment advisor, speaking to them about what your needs are, what your goals are, and following through on that game plan. Closely related to the previous myth is this next one, which is that I can put off savings because I'll just retire later. And delaying investing means losing the greatest retirement planning asset you have on your time, which on your side, which is time. While many Americans think that they'll have many years to get ready for retirement, the reality is that uh, things can be very different from what you expect. In fact, according to the 2024 Retirement Confidence Survey, which is the longest running survey of its kind, half of retirees said that they retired earlier than expected. Also, about 40% who retired said that they did so because they could afford it, which is just under half of people who were content with retiring early. On the other hand, about 70% of these retirees indicated that the reason they retired earlier was because it was out of their control, because it was for a bunch of different reasons. It could be stuff like losing their jobs, could have been because they fell ill, or that they needed to take care of a family member. And the truth is, in an ideal world, retirement would begin when we were ready, when we could afford it. But in a less than ideal world, it begins when your health fails you. It's when you get laid off by your employer, or you can no longer work for one reason or another. And if you want any kind of control over how that retirement process is going to look like, you do not want to put off investing. The fifth myth is something that may be in your subconscious, is that I can time the markets, or better yet, my advisor should be timing them for me. The truth is, unless you don't have a crystal ball or a time machine, no one can time the markets. Investors often forget that the cost of potentially higher long-term returns is short-term market volatility, which often freaks them out. And they often also think that they can get in and out of the markets without any consequences. Something that we hear very often is that I'll get out at market highs and buy market lows, but none of us know what the market highs and lows are until that moment in time has passed. And this is a very dangerous misconception. When you get out, you will most likely need more time and need your investments to work harder uh, than had you stayed in the market the whole time. So don't try to time the markets. No one knows the perfect time to get in and out. And on your screen is daily return data from February 1st, 1994, up until January 31st, 2024. So it's about 30 years of daily data for the S&P 500 index. What it shows is that missing out on a handful of the best days over a long-term time period drastically reduces the average annual return you could gain by simply holding on. Uh, so, for instance, missing the best 30 days is the effect of cost cutting your performance down to 1.83% from the S&P return of 8%. And keep in mind, your your historic inflation rate throughout this period has been approximately 2.5%. So you're already underperforming and losing value on your money had you missed out on the best 30 days. Even worse, missing the best 40 days, which took the average annual return to nearly flat 2.44%. And missing the best 50 days resulted in a negative 0.86% annual return on average. Now, the lesson here is that it is time in the markets rather than timing the markets that will help get you to grow your wealth. And what a lot of long-term investors get wrong is that equities accumulate most of their gains over just a few trading days. If you miss those trading days, then you will be behind. And we work with a lot of prospects who come to us after they've panicked and gotten out of the markets. And it's incredibly difficult to get them back in and make up for the growth that they've lost. And what we find more than often is that the reason they got out of the markets in the first place is because they failed to follow through on their investment plan. So work with your advisors, be honest about your risk tolerance and your goals, and try to find something that you will be able to stick to when the sky is falling. So I'm going to hand it over to Raj now. Raj, I believe you have a few important myths to bust.
Thank you, Atha. I appreciate it. And so many great points to dismiss those myths. I think my favorite is that no one can time the market. And that's so true. And that brings us to myth number 6, which is stock market corrections are bad. While it's true they can hurt, history backs this up. So look at your slide, and I'm so glad we're talking about this now when we see the markets are hitting all-time highs again. Account values for most people are all-time highs once again. But one thing is, you have to rest assured there will be a decline, there will be some correction, pullbacks, maybe a recession in the future, and there will be, with different intensity and frequency, for whatever reason, there will be a pullback. But you have to remember, these are and have been regular events. And history has shown that markets have rebounded from these declines, posting strong long-term gains. And if you look at the screen, look at the returns 1 year, 5 year, and 10-year after these market corrections and pullbacks. So instead of viewing market corrections as a bad thing, be prepared for them. Take advantage of them if you can. And remember, time to prepare for the storm isn't in the middle of the storm, it's well in advance. So this means checking in with your advisor to ensure that your investment plan reflects your risk tolerance and your goals. If you've experienced any major life changes, you recently got married, you had a newborn, you're nearing retirement, a divorce, maybe the business isn't doing so well, or it's doing really well. These are the things that you must touch base with your advisor on and let them know so that the necessary adjustments can be made to your investment plan. And then knowing that you're prepared for the next market correction will hopefully give you the confidence that you need to stick to your plan. The next myth we'll talk about is that buying gold or other commodities is the only safe investment. Investors typically turn to these types of investments like golds and commodities during times of volatility and uncertainty. And proponents of gold use fear, scare tactics, to try to convince people that gold is a safe investment in a collapsing world. They talk about how the financial system is going to collapse, or the world is going to crumble, or the stock market will have such a pullback or a crash that your portfolio will be worthless or go to zero. And that's simply not true. You have to remember that we do face many challenges in the world today, but that's nothing new. And as we've seen, stock markets have continued to rise over time. Now, gold definitely has had periods of strong performance, but these are hard to predict. And in between these moments, stocks typically, they outperform gold. Look at the performance of gold versus stocks going all the way back to 1973. The average return of gold has been just over 6.2% versus 11% when compared to stocks. Now you might say, well, 5%, that's not that big of a difference. Well, I think if you look at it cumulatively, 1,800% versus 17,000%, that is a significant difference. So what that means is if you invested $1 in gold back in 1973, it would be worth $1,848. Versus if you invested that same dollar in stocks, it would be worth over $17,000. So the difference is significant. And the point here is that there is no such thing as a safe investment. All investments have risk. If you're investing overseas, you have currency risk, you have political risk. You hardly have any legal protection in case something goes wrong. If you invest in a private fund, there's lack of transparency, there's liquidity issues. When you need the money, you can't get it out. And again, your legal protections within a private fund are also very minimal. And if you're not investing, you're staying in cash, you have inflation risk, right? Your money is losing power. So everything has risk, even real estate. It's just a matter of determining if that risk is appropriate for you and if it's justifiable. Now, the S&P 500 has captured a lot of the headlines lately, but we always have to remember that the S&P 500 has not always been the leading asset class. So that brings us to our next myth, which is I can ignore asset allocation and simply just put all my money in the S&P 500 index. Now, many of us have forgotten the lost decade. If we look back from December 1999 to December 2009, large caps that are represented by the S&P 500 index was actually a negative 9.1%. That's right, it's correct, negative 9.1 over that entire 10-year period. The annualized return was negative 0.9 for that same period. Now, on the other hand, investors with a diversified portfolio actually had very strong positive returns. And this is because other asset classes like small cap value and international, they performed very well. US small cap value returned just over 139% cumulative return, and many other asset classes did well over 100% over that same time. Our ninth myth is that you should always compare your portfolio's performance to the S&P 500. Now, the S&P 500 is just one benchmark. It's one of many indices or one of many benchmarks out there. And S&P 500 compares large cap growth stocks. It does not compare to a risk-adjusted diversified portfolio. And as demonstrated on the slide on your screen, no asset class stays on the top or at the bottom for a very long period of time. Certain asset classes do well in certain years, while others not so well. And as Azad, we provide our clients with a managed account and a diversified group of asset classes like REITs, international, small cap, mid cap, and large cap stocks. And then we combine equity with halal fixed income for an asset allocation strategy that aligns with your risk tolerance. Remember, true diversification involves investing in different types of assets, not just all in one asset class. And the key to diversification is to invest in assets that have low or negative correlation with each other. And this spreads the risk and reduces your overall volatility. When one asset class is underperforming, another one might be outperforming. And this helps to balance out your portfolio risk. Next, you rebalance your portfolio. Rebalancing means bringing your investments back into alignment with your objectives and your comfort of risk. Now, of course, how you allocate your assets depends on your risk appetite, your time horizon, the goals you have for a particular account. So, for example, if you're a moderate investor, you have 40% fixed income, 60% equities. According to that allocation mix, your performance going back to 2009, annualized would have been 7.5%. As you can see, this is not the S&P's 13.9% performance as shown on this chart. Next, we'll talk about fixed income. Now, to properly diversify, you have to have equity and fixed income into your portfolio, and this actually controls the level of risk. So, but the majority of fixed income, as we know, is riba-based. So one of the myths that exists is that there's no halal fixed income options for Muslims. This is actually not true. In fact, it hasn't been true since 2010. That's when we launched the Azad Wise Capital Fund. The Wise Capital Fund is similar to short-term bond fund with holdings that have a maturity of 1 to 3 years at most. The fund aims to deliver income while limiting volatility associated with longer-term bond strategies. The focus here is capital preservation through high-quality diversified investments. Now, these investments include sukuks, Islamic bank deposits, and trade finance. The fund is actively managed by a 3-person team at Federated Hermes. They have extensive experience in this area, and they're a multi-billion-dollar firm. The fund's track record actually dispels this myth that there is no halal fixed income option. WiseX has performed very similar to its benchmark, which is the ICE Bank of America 1 to 3 year. And that's the benchmark that's used to measure performance of short-term fixed income, not the S&P 500. Now, for more information on the Azad Wise Capital Fund, please visit our website, read the perspectives, and it's also available for purchase at your favorite brokers, such as a Fidelity, Schwab, or E-Trade. Now I'm going to turn it over to our CEO, Bashar.
Thanks, Raj. Probably the most common misconception I hear about Islamic investing and Islamic finance in general is that it is all the same. This is myth number 11, if you are keeping track. Critics will say it is just different labels for the same thing. Well, to really know if it's different, you need to take a closer look under the hood. The destination should be the same. After all, you want to purchase a house, you want to invest for your retirement nest egg, you want to build your wealth. The destination should be the same. The difference lies in how you get to your destination. On your slide here are a few questions we encourage you to ask about and ask anyone who claims they can provide you with halal investing. Also, remember one more thing. If you are working with a financial advisor who is providing you with quality planning advice, they also need to be aware of how Islamic financial principles work in planning, how they affect estate planning, charitable giving, retirement planning. You don't go to a chiropractor, for example, to prescribe you an anti-inflammatory medication or to perform surgery in your back, right? For that, you go to a spine surgeon or an orthopedic specialist. So you should be working with a financial advisor who is using other funds, including the Azad Mutual Fund, but who is still unknowledgeable about Islamic financial concepts and ends up recommending you purchase an annuity or take out a home equity line of credit or HELOC. You will also want to confirm that they not only have the expertise, but also the tools to service you properly. Here on your slide are a few questions. I encourage you to ask them. What is your halal investment process? Is the halal investment process promised to me in the investment advisory agreement? Does the advisor have the resources to implement halal investing, i.e., people, processes, and tools? Is the advisor's firm's dedication to halal investing in their mission statement? Do they have a dedicated certified Sharia auditor and advisor, a designation by IOFI, by the Accounting and Auditing Organization for Islamic Financial Institution, or similar experts on their staff? Do they have a Sharia advisory board? Is there a third-party oversight? Myth number 12 is just like the previous one, but this time it's the notion that all financial professionals are the same. It might surprise you to hear this, but not all financial professionals are required by law to act in your best interest at all times. If the advisor acknowledges he is held to the fiduciary standard, then it should be in the agreement with you. When you call a broker-dealer like Schwab, Fidelity, the person on the other line is most likely going to be a registered representative. Registered representatives are generally not fiduciaries. They are governed by suitable standards, which means they must only suggest products that are suitable for your age, your income level, and your objectives. Broker-dealers are not fiduciary either. On the other hand, registered investment advisors, or RIAs for short, are required to act as fiduciaries and follow the highest legal standards known as the trust standard. This means they must put their clients' interests first and avoid conflicts of interest. They must also disclose any risk or potential conflicts of interest to their clients. Think of it like this. Suitability means selling you a suit that fits you. Fiduciary duty means it has to look good on you too. Josh, I'm going to turn this to you to do the next one.
Thank you, Bashar. Myth number 13 is you need a high income to achieve financial success. So, according to a study, 93% of millionaires got their wealth because they worked hard, not because they had big salaries. Actually, 31% averaged $100,000 a year over the course of their career, and one third never made six figures in any single working year of their career. And before you think, well, they must have gotten a nice inheritance, study says that 8 out of 10 millionaires come from families at or below middle income level, and 79% did not receive any inheritance. So, what turned these engineers, accountants, teachers, managers, and attorneys into millionaires? Well, 75% of them said regular, consistent investing over a long period of time is the reason for their success. I would also add boring, uneventful investing. So that story about the young computer genius who developed an app that earned millions overnight is the exception, not the rule. Just like the story about your next door neighbor who made it big in Bitcoin.
That's right, Josh. I like that. Boring, uneventful investing. And I would also add boring, uneventful investing that's being done in tax-advantaged accounts. So that brings us to our next myth, which is investing in tax-advantaged accounts like traditional IRAs, 401ks. They're no different than investing in a taxable account. Now, this myth stems from a lack of understanding the time value of money. Let's take a look at your screen. Let's say you have $20,000 to invest. You invest $10,000 in a taxable account that earns 6%, and you use a portion of these assets along the way to pay your ongoing taxes. And then you put the other $10,000 in a tax-deferred account that also earns 6%. Assuming you're in the 24% tax bracket, after 30 years, your taxable account will be a little bit above $38,000. And in the same amount of time, the tax-deferred account will be above $57,000. Now, of course, you might say, well, you've deferred the taxes, you got to pay them. And you're absolutely right. The tax-deferred account will be subject to taxes when you withdraw this money. But even if you withdraw this money and assuming that same 24% tax bracket, you still end up ahead with well over $43,000. Now, of course, you have to remember that an additional 10% penalty does apply to tax-deferred accounts if you take the money out before a certain age or for non-qualified purposes. And additionally, this illustration assumes a fixed rate of return over a 30-year period. And we all know that returns do vary, market conditions vary, and this is absolutely true for long-term investing. So the next question is, how much of my pre-retirement income do I need to save? And there's many general guidelines out there. You know, save 75% of your pre-retirement income or 90% of your pre-retirement income. Now, the truth is, how much you'll need is unique to you. Everybody's different. And so it depends on the retirement you plan on having, where do you plan to live, the state of your health, and many other issues. But according to Employee Benefits Research Institute, 52% of retirees surveyed, they said they spend 95% or more of their pre-retirement income during retirement. So as you can see, there's another myth that your expenses will go down during retirement significantly. Now, for some, that might be the case, but you really don't want to end up underestimating how much you'll need. And it's true, as you age, you can expect some of your expenses to go down. Maybe your mortgage goes away, house-related expenses come down, especially if you downsize. However, you can expect other expenses to go up due to inflation, rising cost of healthcare. And when you have time, you'll probably travel and have some additional hobbies. All those will cost money, and you don't want to underestimate for those. Also, don't forget Medicare, which is the typical insurance that most retirees are on after age 65. It doesn't cover long-term care. So it's important to consider the impact that long-term care can have, potentially either nursing home or in-home care. Now, these are all the different variables that you want to plan for, that your financial planner can help with as you're accumulating your savings for retirement. Now, on the flip side is only invest in pre-retirement, pre-tax retirement accounts. And this is our next myth. Let's say for decades, you've invested only in pre-tax contributions. You've compounded your investments all these years. But remember, as your retirement accounts have grown, so has your tax liability. And when it comes time to withdraw this money, it's subject to income tax. And the tax that you've been delaying through these contributions and tax deferred earnings, it comes due. And this is what we call the retirement tax time bomb. Effective pre-retirement planning can lessen some of this. There are strategies you can use to reduce the impact of taxes on your retirement income. And this includes building a taxable brokerage account alongside your retirement accounts. Remember, most of the high income earners will need to save above and beyond your 401k and IRA maximum contribution limits to secure the right future. And brokerage and taxable accounts are not subject to required minimum distributions. And they're also taxed at realized gains rates, which is lower than ordinary income rates. In addition to that, having a Roth account can also diversify your tax outcome, because these accounts are not subject to RMDs, and withdrawals from Roth accounts are generally income tax free. Now, remember, high income earners can't contribute directly to a Roth, but there are other ways to build a Roth account, one of which is a Roth conversion. Now, quick note, Roth conversions usually result in a tax bill. So it's essential you work with your advisor as well as your accountant for a strategy that's right for you. Next myth we'll talk about is taxes aren't important. Now, we all know they're important, but sometimes we overlook or underestimate the impact taxes can have on our bottom line. Taxes can eat into your income, significantly reducing the amount you have available to spend during retirement. Now, understanding whether your income is or is not subject to taxes is very critical. For example, many people are surprised to learn that a portion of their Social Security is subject to federal tax. You also want to make sure that you understand how all of your retirement income is taxed. For example, interest and short-term gains and non-qualified dividends, these are normally taxed at ordinary income rates, while other incomes like long-term capital gains, qualified dividends, generally have lower capital gains tax rates. Some fixed income can be completely exempt from federal income tax and sometimes state tax as well. Also, you must understand how distributions from your tax advantage accounts like 401ks and traditional IRAs are also taxed. And these are taxed normally at ordinary income, regardless of whether these investments had gains or paid dividends. Special rules do apply to Roth accounts. Qualified distributions from Roth accounts are usually exempt from federal and state taxes. So to be clear, paying taxes isn't necessarily a bad deal. And sometimes it's better to pay them now in exchange for a greater benefit later. For example, exercising a company stock option, or maybe doing a Roth conversion. Understanding the taxes impact all of your investment decisions means it's critical you communicate with your financial advisor before making any financial decision. There are strategies we can use to soften the impact of taxes on your bottom line. Taxes are important. That's why at Azad we work with our clients and their accountants to provide tax-efficient planning. Ata, can you talk to us a little bit more about this, please?
Sure. And this brings us to our 17th myth, which is that you don't need a financial planner now that you're in the decumulation or distribution phase. It's quite the contrary. Up until this point, you might have been in the accumulation phase of your life, and as long as you lived within your means, invested in a well-diversified portfolio, and didn't do anything stupid, you could focus on just doing that, accumulating wealth. However, once you transition to retirement, even if you're still working part-time, you might find that you need some professional service or professional help to assist you with readjusting your portfolio or calculating the tax impact of different retirement scenarios. Which is why at Azad we use sophisticated tax planning and planning softwares to help us analyze various scenarios to give us a roadmap to implement these strategies. These strategies and these roadmaps can then help mitigate some of the tax impacts that you might have, or streamline those expenses in your retirement phases. And we believe that it's this proactive approach that can offer you a much smoother ride in retirement. But before we move on, I think something important to point out is that we've been talking about taxes only so far, but especially in retirement, but we haven't even begun to talk about the cost of healthcare, which inevitably in most cases goes up over time. But again, your financial planner can incorporate all these expenses, including healthcare, into your plan for a withdrawal plan that can help you outlive your savings. And it's important to keep in mind that no two financial situations are the same. And if you've been listening on this presentation and this webinar from the beginning, one thing that you'll consistently note is that we talk about how no two plans are the same. They're tailor-made to you, just like a tailor-made suit. It fits you, and it might not fit the next person as well as it does to you. So speak to your advisor, figure out what your needs are, and then help them understand your needs that can be incorporated into your financial plan. Myth number 18 is that you don't need financial planning. And if your financial situation is simple, if you're maybe starting off in your career, it's possible that you don't need as much complicated financial advice as you might need in the later phases of your life where you're in the full swing of accumulating wealth. However, that's a little misguided, and I kind of to using a tax preparation software versus going to an accountant. Uh, at some point, you're going to outgrow the need for the tax planning software, and you will eventually need someone who can navigate those complexities that you're experiencing in later phases of your career. And that millionaire survey that we referenced earlier, that also found that 68% of millionaires work with a financial advisor who provides them with financial planning advice. And most began doing so before they achieved millionaire status. And that's primarily because they understand that they don't know what they don't know. They're willing to accept the uncertainties. And several other studies have shown that the money you spend on financial advice, that financial planning pays off. In fact, these studies place the value of financial advice at anywhere between 2 to 3% per year in excess returns. Russell Investments did a study last year where they put the potential value of advisors at over 5%. And the largest component of that total value comes from behavioral coaching. In other words, helping you to stick to your long-term investment strategy, helping you not overreact to market volatility, and not chase performance and avoid making costly mistakes. So I'm going to hand it over to Bashar because I know that the next myth is a pet peeve of his. So Bashar, over to you.
Sure, Rata, thanks. I am using another advisor because I want to be diversified. This is the 19th myth we want to bust. It's a pet peeve because clients don't realize how much potential harm they are doing to themselves believing this myth. Diversifying your investment across multiple advisors may seem like a prudent strategy, but it can jeopardize your financial success. When different advisors develop their strategies in isolation, their recommendations may conflict or overlap, and that jeopardizes your financial success in several ways. It can lead to over concentration in certain assets and underexposure to others. Your overall portfolio may not be aligned with your goals and risk tolerance, exposing you to more risk than your goals require. It can also lead to higher costs with reduced services. You may also end up with a higher tax bill. Without a holistic view of your investments, none of your advisors will be able to provide you with efficient tax planning. You might also be getting contradictory recommendations that might even cause you to be making inaccurate performance comparisons. Those contradictory recommendations may cause you to be indecisive and not take any action. Using multiple advisors not only is not diversifying your portfolio, but it also makes it challenging to assess your overall progress toward your financial goals. Let me ask you this. Would you go to 3 different physicians to treat the same illness? Worse yet, would you go to one physician and not tell the other 2 physicians what medication that other physician prescribed you, and then take all their medications? It is important to carefully consider the trade-offs and work with a single trusted advisor who can provide you with comprehensive approach to your financial well-being. Josh?
Thanks, Bashar. We're going to end our presentation today with myth number 20, which goes back to risk. And it's the idea that I can earn very high returns with minimal risk. This is simply unrealistic. As I hope we've emphasized to you in today's presentation, your portfolio's return will depend on several factors, including the market environment, your asset allocation, and your time horizon. In fact, we didn't mention this earlier, but your portfolio's allocation to different asset classes can determine as much as 90% of how your returns may vary over time. Keep in mind, risk and return do go hand in hand, so the more you invest in stocks, the more risk or chance for higher volatility you'll take on. Some people also have the misconception that if they take on greater risk, somehow they're assured to get back a profit. Psychologically, they ignore the you have a greater chance to lose money and focus more on the more potential for return. For example, investing in a highly concentrated stock portfolio of expensive innovative or innovation stocks doesn't guarantee that you'll make a higher than average return. It means that you're taking on greater risk for the potential for greater returns. Always keep in mind that past performance cannot guarantee future results. On the flip side, sometimes you have to take greater risk to achieve your goals. The sweet spot is to take the appropriate amount of risk that's absolutely necessary for achieving your goals. At Azad, we are hyper-focused on the role that risk plays in our clients' portfolios. What this all means is that it's critical that you maintain a line of communication with your Azad advisor. We are not mind readers. We need to know what's going on in your life, and we need to make sure that your investments are working for you. That's going to conclude today's presentation. I'd like to thank our special guests for being here today, and a special thank you to all of you who took the time to be here with us live. If we did not get to your question, or if you'd like more information, please reach out to us. The email address is hello@azadasset.com, and be sure to follow us on YouTube and Facebook using the handle @AzadFunds. You can find us on LinkedIn under our full name, Azad Asset Management. Thank you again, everybody, and have a great rest of your day.
Thank you. Assalamu alaikum.
Everyone, assalamu alaikum.